Let me begin with you, Jay. What will this actually restructuring look like, and what is that strategic rationale behind getting this kind of a restructuring done?
So basically, UPL over the last 50 years has built a very strong platforms. So we have a very strong manufacturing platform, which is called Superform. We have Advanta, the seed business, which is one of the most valuable seed companies in the world. And we have the crop protection business, as you rightly said, is the second largest pure play crop protection business in the world. So we feel that it's the right time to unlock shareholder value in each of these platforms. And this is part of that reorganizing. As you know, we have already filed the DHRP for Advanta with SEBI and waiting for approval. This will be the second part of unlocking value, where the UPL shareholders, UPL Limited shareholders, will get mirror image shareholding partially in the crop protection business, and it will be automatically listed. And then we have Superform, where we could also raise capital and list it, and that is under discussions.
Okay. So, Jay, tell me one thing. You're talking about a pure play positioning over here. If being a pure play positioning, entity will improve UPL Global's valuation, if so, how will that be as compared to the previous integrated structure?
So when you have a pure play structure, the decision making for the management team becomes a lot more, and we can be a lot more agile. As you know, the global markets, and we operate in 140 countries. Agility is key to continue to be able to be a leader in and gain market share. And we believe that each of these platforms, when they are independently listed, while they are part of the group, will have the ability to make quicker decisions, and therefore continue to grow faster than the rest of the industry.
How we have looked at it is, you have operating performance leading to financial performance, leading to valuation. And we believe that each of these pure plays, the kind of focus that one can have, the kind of capital allocation, unlocks lots of avenues for growth on the operating side and the synergies, which leads to superior financial performance, which hopefully will reflect in the valuations from an investor and board's standpoint.
Okay, so thanks, Toshan, for that. In fact, Jay, if you're talking about manufacturing synergies as well, post the demerger, what are the kind of manufacturing synergies that will exist for UPL, which is the first part, the original business, which will specifically focus on specialty chemicals? And what are the kind of long-term supply agreements between the manufacturing heavy, which will be UPL 1, and the sales focused, which will be UPL Global?
Yeah. So as Superform, we operate as a crop protection. We manufacture crop protection for the UPL Limited, but we have a very strong specialty chemical platform also, where we cater to pharma industry, we cater to paint industry, oil field industry, flame retardants, textile industry, batteries, and those areas. So we have a very strong customer base across, and with the strong manufacturing capabilities and the core competence around so many different chemistries, where we have a very, very strong strength. Now, we think that the ability for us to ride the growth in the Indian GDP, as the Indian GDP grows, the need for specialty chemicals for pharma, for other sectors, for so many sectors, will really help us to continue to grow that and leverage on that manufacturing platform, which we had built originally for just the crop protection business.
I was saying, Jay, I think continuing is the front end and back end. I think we believe the synergies, and that's where I think Hiral, you alluded to very correctly, the supply agreement, make sure that Superform is extremely cost competitive and a very reliable supplier to UPL Global crop protection at the front end. We have seen now in this industry that if your source, the supply is not reliable and is not cost effective, the the chances of it affecting your bottom line adversely, which has happened interestingly to many of our peers, we wanted to make sure that with this restructuring, we avoid that. On the same time, we are making sure that the front end will buy from Superform as well as is free to buy elsewhere also, if Superform is either not able to provide or not the most cost competitive, which is not the case. But the crux really is this linkage is what we wanted to maintain, because that's what will make our crop protection entity continue to be a leading position across the markets in the world.
Okay. The other aspect that everyone's worried about is what happens to the debt, because we are talking about $3.8 billion, which has been reported. How will that structure work?
I think if you look at it, all the three entities, the Advanta business is cash generating and is actually, there is no debt in Advanta. Even if you look at the India crop protection business, SAS this year is actually, there is no debt there. So the net debt is actually negative. So it has also generated cash. All the debt is for in the crop protection entity, which will stay there. So we are not transferring debt anywhere, but the net debt will actually be much lesser, because what you're combining is an entity which has debt with an entity which is net debt negative, which has the cash. So the overall net debt position for this business will be lesser. But if you look at also over the next 12 to 18 months, we will continue to deleverage. As Jay mentioned earlier, the Advanta DRHP is an offer for sale, where UPL will actually be generating cash from the purpose of deleveraging. Over the next 12 to 18 months, we may do corporate action in our specialty chemicals business, which is again very exciting, as well as the internal cash flow generation. All of these three, we believe, will ensure that the net debt position is going to be much better, far in the lesser sub 2, where by the time the listing actually happens.
Is indicating. Very lastly, how about the valuation ratios? What is that final share entitlement ratio for the existing shareholders, and how would this actually account for the remainder 9% minority stake that has been held by, say, TPG, Brookfield in the India business?
I think it's a great question. I think what's happening is that as a part of the reorganization, the 9.09% stake actually merges back into UPL Limited, post which, as a part of the 1:1 vertical demerger, all the shareholders of that entity get shares in UPL Global. And the last step is the merger of the international crop protection business. So the 9.09 stake of TPG plus ADIA plus Brookfield gets subsumed in step 1. There is also TPG and ADIA, not Brookfield, in the international crop protection business, which, as a part of the third step of the merger, gets subsumed for UPL in UPL Global Agri Solutions. So at the end of it, you have a 1:1 demerger. So shareholders of UPL Limited, in addition to their shareholding in UPL Limited today, get additional shares in UPL Crop Protection in the new entity, which I think is a phenomenal addition to, and should hopefully help the shareholders of UPL Limited to get value accretion from the crop protection play.
Okay, value accretion from the crop protection play. How much will it be? We'll see once the markets open as well, because the market's not really reading the restructuring well so far. But thank you so much for joining in, Jay and Toshan. Always a pleasure to speak to both of you.